Alright, I promise this is going to be the last economic video I do for at least a few days. This week, I've been dissatisfied with what I've been putting out, and I didn't quite know why. And it occurred to me, all I've been doing is reacting to the terrible economic news we've been getting, and calling out people like Powell and Biden for having ridiculous reactions to it themselves, and I haven't been very reflective. I have not really done a lot, I think, to analyze the data we've been getting, the news we've been getting, and really explain what it means for the future. And historically on this channel, that's what I used to do with economic news. It was something that I felt was, a strength of mine. And I think that I've lost that at some point. So I want to correct that. I want to right that oversight on my part by really discussing what I think the future, the next few months, the next couple quarters, or maybe the next 3 or 4 quarters, let's say the next year, is going to look like. And something's been bothering me about the recession that we're now in. I'm very comfortable saying that we're in a recession. As Bill Clinton put it, 2 negative quarters of real GDP growth, that's enough for me. So the recession's here, but it doesn't feel like a crisis yet. It feels like what Milton Friedman would call a garden variety recession. In that, yes, we have negative GDP growth for 2 quarters in a row, and the economy, is slowed down, but it doesn't seem to be structurally compromised. We're not seeing signs of a systemic collapse yet. But if you're someone who's listened to this channel for multiple years, you know that I'm of the opinion that our entire economy is structurally compromised. It is built on a terrible foundation and is highly distorted by our financial system. Yet, this house of cards hasn't really started to collapse yet. We have high inflation. We have a rapidly rising Fed funds rate, which may be starting to taper off. I would say that the base case, as of now, is that at the next Fed meeting, Powell's only going to hike by 50 basis points. That seems to be what he was signaling, that he's not going to hike by 75 basis points again. Now, that could change, but as of right now, that's the base case, which would put the top end of the target range of the Fed funds rate at 3%. That's the highest it's been in a very long time. And it's not that much lower than it was way back in 06 to 08, in which it took only a 5% Fed funds rate to blow up the entire global financial system. And that was, over 15 years ago, when we had a less corrupted and less sick, ill, and malinvested global financial system. There's a lot more crap and brush and kindling that has built up. The forest fire analogy really is the best one. All you have to do is compare the forests of Florida with the forests of California. You look at the forests of California, what do you see? You see a lot of underbrush, a lot of bad growth that needs to be burnt off. But in California, they refuse to do controlled burns. In Florida, we do periodically, multiple times a year. We burn our forests, and that keeps them healthy. It makes sure that only the strongest plants survive, and we don't end up with this mess of flammable, dead organic material that is ready to go up in flames at the slightest spark, like you have in California. The current U.S. economy is like one of those California forests with an extra 15 years of bad growth built up. 15 more years of companies being, limped along via debt by just rolling over their debt, zombie corporations, 15 more years of new companies that aren't profitable being created and sustained by debt, all of which is going to go up in flames at some point, but hasn't yet. And despite this, we're already in a recession. And that recession, I think, is not just a spark, it's a small fire in that big forest. A fire which is going to spread and likely trigger a much bigger and more disastrous fire. That's the other shoe which has yet to drop. What we have to worry about now is not avoiding a recession or trying to recover from the recession we're already in. What we need to worry about now is contagion, in the recession spreading and dominoing and pancaking, to use a 9/11 analogy. It's hard to say where it will start and what sectors we'll see a big crisis. Last time it was with the banks. I've heard a lot of people who know more about how the banking system works than I do, who have said that this time around, if we have a big crisis, it's not going to start with the banks. And that makes sense to me. You know, these crises never start in the same place. It could be related to, the housing market, which is already in free fall, or the stock market, which, is taking a bit of a pause, but is certainly well off of all-time highs. But at the end of the day, before we're through this, I think it's safe to say that things will have to get much worse than they are right now. There's going to be a major leg down. There's going to be a big bump in the road that we haven't felt yet. And so, as far as this channel's concerned, I think I'm going to shift my focus to waiting for that. Whatever that is, there's going to be some big event. I hesitate to call it a Lehman moment, but that's what we're looking for. A moment in which people realize that this is not just a garden variety recession, that this is an existential economic crisis, because it most certainly is. This is a continuation of the 2008 crisis. Back in 08-09, what the Fed tried to do was hit the pause button. They were successful at that. They hit the pause button. But in hiking interest rates in the way that Powell has, he's unpaused the 2008 financial crisis. And even if he stops hiking rates, I would argue that maintaining rates at, let's say he goes, he starts tapering rate hikes. He goes 50 basis points at the next meeting, then 25 basis points at the meeting after that, and then nothing more. Well, then we get to 3 to 3.25%. That'll be the range for the Fed funds rate. Our economy couldn't handle a 5% Fed funds rate back in 06, 07, 08. It's not going to be able to handle a 3.25% Fed funds rate today. Even if Powell just raises rates to there and then says, you know what, I don't care about inflation anymore, and just lets the Fed funds rate sit, lets inflation run hot, we're going to run into a crisis. The clock's ticking at this point, essentially. The game started. Every Great Depression starts out as a garden variety recession. What makes something a depression is how it continues to get worse and worse until people figure out at some point that this is a crisis that they will not soon escape. It's not just a matter of, okay, business is going to be slow for a period of 18 months, which is how recessions used to be back in the 19th century. A recession lasted 18 months, max, from peak to trough. And then you were off to the races again, and you could get back to business. Or you know what? That sounds wrong. I might be rusty in my economic history. I think I meant to say that recessions used to occur once every 18 months, but they were very, very short, like only a matter of a few months. I think we're gonna have to bust out a bunch of the old books from from college and brush up on some economic history and some good old business cycle theory, because I'm going to be needing that. I'm going to be needing good economic knowledge over the next couple of years, because declaring the recession to be official, that's not the end of this story. We're at the beginning of this story. So, with that said, I will see you folks back here tomorrow.